Welcome. Today we are deconstructing a detailed analysis of Haitian International, a global leader in industrial manufacturing. The central issue we'll be examining is a significant disconnect between the company's market valuation and its underlying operational performance.
Let's begin with the data that frames our entire analysis. This chart illustrates the core anomaly. In September of 2025, as the broader Hang Seng Index posted a gain of nearly 5%, Haitian International stock remained essentially flat. This divergence raises a critical question. What is the market pricing into the stock that isn't reflected in the broader index?
The central thesis of the analysis is this: the market is exhibiting a form of myopia. It appears to be overly focused on a temporary and, importantly, explained slowdown in orders. In doing so, it's potentially overlooking two powerful structural growth drivers, accelerating overseas demand and a new high-margin product cycle. The result is a valuation that appears disconnected from both its historical levels and its peer group.
Here is the agenda for our analysis. We'll begin by establishing the company's market leadership, then examine its primary growth engines and financial health. We'll conclude by assessing its competitive advantages against the operational risks and the central debates surrounding the company. So to begin, what is the core business of Haitian International? The company is a global leader in the manufacturing of injection molding machines, a sector that can be considered the backbone of modern industrial production.
So what exactly do these machines do? You can think of them as sophisticated, self-contained manufacturing units. They melt plastic pellets, then inject the material into a mold under immense pressure, enabling the mass production of complex plastic components with both high speed and precision. The applications for this technology are vast and cut across nearly every major industry. We're talking about automotive components like bumpers and dashboards, appliance casings, consumer electronics, all the way to essential packaging and high-precision medical devices. This ubiquity makes the industry a key barometer for global manufacturing health. Within this critical market, Haitian's leadership position is clear. The company ranks #1 globally by sales volume, operates in over 130 countries, and holds a dominant domestic position with over 40% market share in China. The scale is not just a point of pride, it is the foundation of the company's entire competitive strategy. Let's turn now to the first of the two structural growth drivers we mentioned, the company's overseas expansion. The data suggests this is a key part of the story that the market may be underappreciating.
This single data point is striking, a year-over-year growth rate of 34.7% in overseas sales for the first half of 2025. This represents a significant acceleration and stands in sharp contrast to the performance of its domestic business.
And here, you can see the direct impact of that growth on the company's revenue composition. In just 1 year, the contribution from overseas sales has increased from roughly 35% to over 42% of the total. This illustrates a rapid and strategic shift in the company's business mix.
This table quantifies that divergence. You can see domestic sales growth was nearly flat at just 0.3%. Meanwhile, overseas sales grew by that powerful 34.7%. This stark contrast underscores exactly where the momentum in the business is currently concentrated. This international push is not opportunistic, it is strategic. It's part of a stated corporate objective known as the dual 10 billion goal. The aim is to achieve 10 billion RMB in domestic sales and, crucially, 10 billion RMB in overseas sales within the next 3 to 5 years, effectively rebalancing the company's global footprint. Of course, top-line growth is only one part of the equation. The quality of that growth is revealed in the company's profitability. An analysis of the financials suggests a core operational efficiency that is quite remarkable. Here we see key profitability metrics from 2022 through 2025 estimates. Note the revenue growth volatility, which is characteristic of this cyclical industry. However, the key insight here is the stability and even slight expansion of both gross and net margins through this period. This consistency suggests strong pricing power and effective cost management. A DuPont analysis allows us to deconstruct the company's return on equity. What it reveals is that the ROE is primarily driven by a high net profit margin and efficient asset turnover, rather than high financial leverage. In other words, the returns are generated from operational excellence, not from taking on significant debt, which indicates a higher quality of earnings.
So, how durable is this performance? That leads us to an analysis of the company's competitive advantages, its economic moat, and the potential catalysts for future growth.
The company's competitive moat is built on several pillars, but it begins with economies of scale.
Its massive production volume grants it superior bargaining power with suppliers. This, combined with an efficient modular production system, establishes it as a cost leader. The strategic outcome is a compelling value proposition, offering performance that competes with German and Japanese rivals, but at a significant price advantage.
Looking forward, the analysis identifies two key potential catalysts. First, the shift from an export-led model to a global manufacturing footprint, with new plants coming online in key regions. This move is designed to mitigate tariff risks and reduce logistics costs. Second is the introduction of their fifth-generation product line. These machines offer significant energy efficiency gains, which could create a strong replacement cycle, especially given high energy costs and increasing ESG considerations for manufacturers.
This valuation table makes the market disconnect quantitative. If you compare Haitian International to its peers, you'll note that despite posting a superior net margin to several competitors, its valuation multiples, both on a price-to-earnings and price-to-book basis, are considerably lower. This is the valuation gap we referred to at the beginning, shown in the data.
For a balanced perspective, it is crucial to examine the potential risks and the prevailing counterarguments that form the bearish case against the company.
The primary risks can be categorized into four areas. First, macroeconomic cyclicality. The business is highly sensitive to the global capital investment cycle. Second, geopolitical risk, particularly the potential for new trade tariffs in key markets. Third, commodity price risk, as spikes in materials like steel could compress margins. And finally, rising domestic competition, which could introduce future pricing pressure. And all of this culminates in the central debate surrounding Haitian International. Is the company at a cyclical peak, or is it at the beginning of a new phase of structural growth? The bear case posits that recent strength was a one-off event and the cycle is turning down. The counterargument, the bull case, is that this growth is structural, underpinned by durable shifts in global supply chains and a new product cycle that will drive its own demand.
This leaves us with a fundamental question. When a company's operational fundamentals and the prevailing market sentiment diverge so clearly, which proves to be the more reliable long-term guide? The answer will ultimately be revealed in the company's ability to execute on its long-term strategy amidst short-term market noise.